Hello, we're going to take a look here at Chapter 10, and we're going to talk about the cost of capital. So what are some sources of capital that businesses can accumulate? What are the component costs? How do we adjust for what are known as flotation costs? And that's going to bring us to the major topic from this chapter, WACC, or weighted average cost of capital. And finally, also, how do we adjust for risk? So what sources of capital do companies or firms utilize? Capital falls under three umbrellas. We have debt, and those are our bonds and short-term debt instruments, so long-term debt or bonds and notes payable, preferred stock, and then common stock. Common stock or common equity can take two forms. We can draw from retained earnings or issue new common stock. Why are retained earnings common equity? Because our stockholders own the company. Therefore, our retained earnings fall under the common equity umbrella. So what is our weighted average cost of capital? Our weighted average cost of capital is what is the cost of a company to accumulate funds to use in projects. And it's simply a weighted average. Weight of debt times our R of debt or interest rate times 1 minus the tax rate. The reason we do this for debt is tax deductible. If we issue bonds, we can write off our interest payments off our taxes, so it actually effectively reduces the cost of debt. 1 minus our tax rate is going to shrink our debt component. And then weight of preferred plus return on preferred, weight of common plus return on our common stock. Now, what is that going to do? Give us our weighted average cost of capital. The W's refer to the capital structure weights, so how much of our capital structure is debt or how much is common stock. Those are the weights. And the R's are the cost or the interest rate of each component. Should our analysis focus on before or after tax capital costs? Generally, stockholders focus on after-tax cash flows, so we should only focus on after-tax capital costs. Use after-tax costs of capital in our weighted average cost of capital. The reason being, once again, debt is tax deductible. Only the interest rate for the debt or RD needs adjusting because that's the only one that is tax deductible. Interest that we pay on our debt, on our bonds and notes and all of that, that is tax deductible. The other ones are not tax deductible. Should our analysis focus on historical costs or new costs? So, costs of capital is used to make decisions in the here and now involving raising new capital. So, focus on today's marginal costs for our weighted average cost of capital. So, we're going to want to focus on today's costs for our weighted average cost of capital. So how are the weights determined? Use accounting numbers or market value, use actual numbers or target capital structure. So generally, in the problems we're going to look at, the weights will be in part of the problem. But generally, companies set what is known as a target capital structure, where they want 40% of their capital structure to be debt or 30% to be common stock or so on and so forth. But the actual numbers may differ. Targets are not always perfectly adhered to, and the actual numbers may vary. However, they try to come close to that target structure, and they may change that structure up as they see fit. So if we want to look at this company here, Coleman Technologies, we want to find their weighted average cost of capital and all that good stuff. They have a tax rate of 25%. They're issuing 15-year, 12% coupon semi-annual bonds, selling for $11.5372. 10% $100 par value quarterly dividend preferred stock, currently selling for $111.10. Common stock is selling for $50. Dividend 0, $4.19, growth 5%. Beta 1.2, risk-free rate 7%, and the risk premium of the market is 6. Bond yield, risk premium 4%, and here's what we mean by a target capital structure. 30% debt, 10% preferred, 60% common. So that's how they want to break down their capital structure. That's what they're currently targeting. So if we look at their capital structure, they are not exactly at the perfect structure. Their debt has a book value of 48%, market value 25%, they're targeting 30%. Preferred stock, book value 2%, market value 5%, and they're targeting 10%. Common stock has a book value of 50%, market value 70%, and they're targeting 60%. Since the number of shares isn't given in the problem, we can't do the actual calculations. It was just an illustration. But typically, your book value capital structure will show a higher percentage of debt because a typical firm's market to book ratio is greater than 1. So typically the book value, or what we booked it at, is going to show a higher percentage of debt than the market one. But they're just showing you that it does differ between book value, market value, and what our target capital structure is as well. So what is the component cost of debt here? So RD is the marginal cost of our debt capital. That is what is our cost of debt if we issue bonds, borrow money in that sense. And remember, it is tax deductible. That's why it's being multiplied by 1 times the tax rate. Yield to maturity on outstanding long-term debt is usually used as a measure of RD. And why do we tax adjust? Well, we tax adjust because we can write off the interest on our debt. Since we can do that, we are able to effectively reduce our cost of debt. They're giving an example here. A 15-year 12% semi-annual coupon bond selling for $11.5372. What's our cost of debt? Since it's selling, paying a semi-annual coupon, we're going to have to multiply our answer by 2. Put N in as 30 or 30 semi-annual periods. Present value, payment is 60. 12% a year would be a $120 payment, or 60 per 6 months. Future value 1,000. It'll give you an interest rate of 5%. The formula to use in Excel here would be equals rate, and you would put in the relevant information. N of 30, PV, payment, and future value. The reason we make PV negative, that would mean we would have to spend that to buy the bond, and remember, bonds at the end of their term pay you the par value as well. That's why it has a future value of 1,000. And since it's paying a semi-annual coupon, that 5% is per 6 months. We would multiply it by 2. So your cost of debt here would be 10%. In this case, would be 10%. So component cost of debt. Since our cost of debt is 10%, but we can write it off our taxes, we're going to multiply that 10% by 1 minus 0.25. And what are we going to get? We're going to get a component cost of 7.5%. So that is the number that gets plugged into our weighted average cost of capital calculation, not the 10%. The reason being, debt is tax deductible. It reduces the rate in a real sense because we can write that interest off our taxes. In this case, use the nominal rate, and flotation costs are small, so we're going to ignore them as well. So that's how we determine our component cost of debt. What about our component cost of preferred stock? Simply going to be our RP, or the return on our preferred stock, multiplied by its weight. Preferred dividends are not tax deductible, so whatever we pay out in preferred dividends, we can't write off our taxes, so it's just simply use nominal RP and multiply that by the weight, and we're going to ignore flotation costs here. Preferred stock, remember, is similar to debt in the sense that it works similar to coupon payments. The difference is if you miss a preferred stock payment, the company is not in bankruptcy, where if you miss a debt payment, you're in default. So preferred stock is what's called a hybrid security. We're going to look at it some more later on in the class in one of our final chapters. but it's not tax deductible. So it's just simply weight of preferred times return of preferred. And what's the cost of a preferred stock? Since it's a form of a perpetuity, if you need the return on it, what do we find? Just simply divide its dividend by its current price. If we do that, it's going to give us our return. So our preferred stock here is paying $10 dividend payments, and it has a current price of $111.10 per share, return of 9% if we round to a whole percent. Is preferred stock more or less risky to investors than debt? Generally, it's more risky. Why? Because debt, a company is obligated to pay. Your coupon payments, if you own a bond in a company, the company is obligated to pay you them. If they don't, remember, they're in default, and that generally leads to bankruptcy protection or flat-out bankruptcy. Preferred stock, a company can miss a preferred payment. It means it's more risky. There's no guarantee, or less of one. There's no guarantees in anything. But there's less of a guarantee that you are going to get a preferred payment because the company isn't bankrupt or in default if they miss one. However, firms try to pay them. They really try to pay them for the two reasons. Number one, by law, if you miss a preferred dividend, you're not allowed to pay out common dividends. So your common stockholders won't get any dividends either. And we're going to go into that in a little, in chapters to come, why that is seldom done. It's generally a very bad sign if a company misses paying dividends. It'll make it difficult to raise additional funds because it's a warning sign. If we miss preferred stock dividends, our creditors or whomever we're raising money from, it's going to send a very bad signal. It's going to send a signal of we're probably in very bad financial shape, and it's going to be difficult to get more money, and your preferred stockholders may gain control of the firm depending on the criteria of that preferred stock. Why is the yield on preferred stock lower than debt? It often has a lower before-tax yield than the before-tax yield on debt. And there's a reason. Most preferred stock are owned by corporations. And the reason being, 50% of preferred dividends are excluded from taxes. So if you're a corporation and you own corporate preferred stock with some of your funds that you just aren't currently using, remember corporations generally will invest unused funds to make something on them, 50% of your preferred dividends are excluded from taxes. So oftentimes it'll have a lower before-tax yield than the before-tax yield on debt, because the before-tax yield on debt is subject to taxation, whereas 50% of your preferred dividends are not. The after-tax yield to an investor and the after-tax cost to the issuer are generally higher on preferred stock than debt, consistent with the higher risk. So if we look at an after-tax sense, preferred stock is generally going to give us a higher after-tax yield. But it is also riskier. Then finally, how are we going to look at equity? Once again, return, RS is the marginal cost of common equity using retained earnings. RE is the marginal cost of common equity when the firm issues new common stock. And we're going to multiply that by the weight. Why is there a cost for retained earnings? Because retained earnings can be reinvested or paid out as dividends. Investors could buy other securities and earn a return. So if earnings are retained, there's an opportunity cost or the return that stockholders could earn on alternative investments of equal risk. So using your own money, retained earnings when you're a company, isn't free because that money can be used for other things. It can make money, it can earn interest for other uses. So as a consequence, they have an opportunity cost. Investors could buy similar stocks and earn RS. The firm could repurchase its own stock and earn RS as well. So, we're going to jump now to slide 19, 3 ways to determine the cost of common equity. We can use capital asset pricing model, which we've looked at already. That's where the return on our common equity is our risk-free rate plus return on the market minus the risk-free rate or the risk premium of the market times beta. Remember, a beta of 1 is the exact risk premium of the market. If it's larger, it's riskier. So that's the CAPM, or capital asset pricing method, and that will give us one example. We could do the discounted cash flow method, where we divide dividend 1 by price 0 plus the growth rate, and that will give us 1. Or we could do our bond yield plus our risk premium. What is our yield on our debt? And then add in the risk premium, and that'll give us a value as well. Generally, all three methods are pretty close. The CAPM one is usually more common than the other two, but we're going to take a look at all of them. So using CAPM, this is one we've looked at here. 7% return on our risk-free securities, such as government securities, plus our risk premium of 6% times beta of 1.2, giving us 14.2%. That is our cost of common equity, or cost of equity, using the CAPM approach. If we use the discounted cash flow approach, it's close, it's a little less. Divide dividend 1 by price 0. So dividend 1 is found by just multiplying dividend 0 by the growth rate, 1 plus the growth rate. So here we go. And then we're going to divide that by price 0 and then add in our growth rate. And what do we get? 13.8%. That's if we use the discounted cash flow approach, or DCF approach. Can the DCF method be applied if growth is not constant? Non-constant growth stocks are expected to attain constant growth at some point, generally in 5 to 10 years, but it may be complicated to calculate. In that case, it would probably be easier to use the CAPM approach. And finally, the bond yield plus risk premium. This is not the same as the CAPM risk premium. This is the risk premium for bonds. So you add that to the cost of debt, and it gives you a ballpark estimate, 14.0. So they're all pretty close. One was a little over 14, one was a little under, one was exactly 14, and it can serve as a useful check as well. So those are the three methods. What's a reasonable final estimate? So using the three methods, we're ranging from 14.2 to 13.8, so you might choose the midpoint. There's no right or wrong answer here, but one way to go would be to use the midpoint of 14. Why is the cost of retained earnings cheaper than the cost of issuing new common stock? And this is important. When a company issues new common stock, you have to pay flotation costs to an underwriter. Remember, common stock is backed by an underwriter who is going to handle selling it to the public, and there's costs involved. Investment banks are not going to help you issue new stock for free. And also, issuing new common stock may send a negative signal to markets, hurting the stock price. If a company announces they're going to issue millions of new shares, it's going to dilute the shares out there. So just by supply or demand, that is going to drop your stock price. And it also may send negative news signals as well. Why is this company issuing so much more stock? Are they desperate for money? Something like that. Are they in bad financial shape? And once again, as a consequence, it may depress the stock price. So if new common stock issue incurs a flotation cost of 15% of the proceeds, what would our return on our equity be? So you do the same thing, dividend 0 times 1 plus the growth rate, and then divide by price 0. Only price 0 is now being multiplied by 1 minus your flotation cost, or 1 minus 0.15, and then you add in your 5% here, our growth rate, and it's now 15.4. It went up. You're dividing by a smaller number. You're dividing by 4250 instead of 50. So as a consequence, it goes up. Why are flotation costs a thing? Because once again, investment banks are not going to handle your new stock issuance for free. They're going to expect to make money doing it, and as a consequence, it's going to make it more expensive. It's going to raise your equity cost of capital component. So in this case, what is our WACC if we ignore flotation costs? So we're going to go with the 14% number. Say we're using retained earnings. In this case, 30% debt times our debt return times 0.75 because it's tax deductible, 1 minus our tax rate, 10% times our 9% return preferred, and then 60% times our 14% return on equity. And you get a weighted average cost of capital of 11.6%. So that number, that weighted average cost of capital, that's what a company is going to expect it to cost them, their money to cost them, if they raise funds to do a project. If you're going to decide on whether or not to take on a project, and that's what we're going to look at in the next 2 chapters to come, weighted average cost of capital is very important because it's going to tell us what is the cost of the funds we're utilizing in this project. So what factors can influence it? Things the firm can't control. Market conditions such as interest and tax rates. Companies can't set their own tax rates. Remember, tax rates are the purview of the government. And things such as interest rates. Interest rates are generally, remember, dependent on things such as inflation and market conditions and all of that. So as a consequence, they can't control that, but it will affect their cost of capital. Factors the firm can control. What's the company's capital structure? What's their dividend policy? And what is their investment policy? Firms with riskier projects generally have a higher weighted average cost of capital. Pretty straightforward if something's very risky. If something is very risky, it's going to generally make it more expensive to raise the funds. Should the company use the composite weighted average cost of capital as the hurdle rate for each of its projects? And this is an important point. The answer is no. Our composite weighted average cost of capital reflects the risk of an average project undertaken by a company. So your weighted average cost of capital is only the hurdle rate, meaning does the project return more than our cost? For a typical project with average risk. Different projects have different risks, so our weighted average cost of capital may have to be adjusted. So depending on what the risk of our project is, it may affect our cost of capital. If a project's really safe, we may be able to borrow money a lot cheaper than if a project is really risky. So our cost of capital is going to change. Our cost of capital, and not always borrow, it could be raise money as well. Our cost of capital is going to change depending on the risk of a project. So the next slide illustrates the importance of risk adjusting. If the company correctly risk adjusts the weighted average cost, it'll select project L and reject H. If they didn't, they would take H and reject L, and let's see why. And that's going to take us to our last slide. So in this case, our weighted average cost of capital is the brown line, and it is changing depending on risk. Project L is going to return 9%. Our weighted average cost of capital is 10%. That's our composite one, or our average. But at the risk of Project L is very, very little risk. We can get funds at 7%. So Project L is a good thing. Even though it's below our normal weighted average cost of capital, it's so low risk, we can raise funds a lot less than our 10% weighted average cost. Whereas Project H is going to return 11, which is more than our weighted average cost of 10. However, its risk is tremendous. It would take 13% to raise the funds for Project H. So Project H is actually going to lose us money in a real sense, whereas Project L will make us money, even though it's returning less than our regular weighted average cost, because our regular weighted average cost is for an average project. That may vary depending on its risk. And that's a very important point. You'll see a few questions on that topic. And that's going to take us to the end of chapter number 10.